I want you to forget everything you think you know about silver right now. I mean that. I need you to wipe the slate completely clean, because what I am about to walk you through is going to challenge assumptions you have held for years. The only way you will truly absorb this is if you come in with fresh eyes, because there is a calculation out there right now, put together by one of the most respected macro analysts in the entire precious metal space, a man named Tavi Costa from Massive Capital, that has done something I have never seen before in all my years covering this market. It has genuinely stopped serious, experienced, hard-nosed investors in their tracks. Not because it is wild speculation, not because it is doom porn dressed up in charts, but because when you sit down and actually do the math yourself, line by line, assumption by assumption, you come to the same terrifying conclusion. And the number at the end of that calculation is not $5 higher than where silver trades today. It is not $20 higher. It is not $20 higher. The number at the end of that calculation is $3,947 per ounce for silver. I saw that number, and my first reaction was exactly what your first reaction is right now. I thought it was absurd. I thought it was clickbait. I thought it was the kind of thing someone says to go viral on social media. But I sat down and I decoded the math. Every single assumption, every ratio, every historical precedent. And here's what I found. The math is not the problem. The math is correct. The debate is about the assumptions behind it. And even when I stress tested those assumptions with the most conservative inputs I could justify, the number I got out of the other end still changed how I think about this market permanently. So today I am going to walk you through the entire framework, show you exactly where I agree with Tavi Costa, show you exactly where I think he is being too aggressive, give you my own version of the calculation, and then tell you what I actually think silver is going to do over the next several years, based on everything I'm watching in the live market right now. Because here's the thing nobody is talking about. The theoretical math and the physical reality happening in the silver market right this second are pointing at the exact same place. And when theory and physical reality converge, that is when markets move in ways that people spend the rest of their lives wishing they had positioned for in advance. Let me start from the foundation, because everything in this calculation builds on one central relationship. And if you do not understand this relationship, the rest of it will not make sense. The relationship is between United States government debt and gold. During World War II, the United States had the largest debt in its history up to that point. Everyone knows that. But here is the piece of that history that most people have never been taught. At the peak of that debt expansion, approximately 51% of all federal debt was backed by gold reserves held in U.S. government vaults. Half. Not a small percentage. Not a fig leaf. Half of everything the United States owed to the world was covered by physical gold. And that backing is what gave the dollar its unshakable credibility as the global reserve currency during the most expensive military conflict in human history. It is what allowed America to emerge from World War II as the dominant financial power on Earth. Now here is where the story gets uncomfortable. Today, the United States government's debt is sitting at roughly $36 trillion and climbing by approximately $2 trillion every single year. And the percentage of that debt backed by gold has collapsed from 51% to roughly 3%. 3. The U.S. still holds 261.5 million ounces of gold in its reserves, the same gold it has held for decades. But the ocean of debt that has been built around that gold has grown so vast that the backing ratio has completely disintegrated. This is the core of Tavi Costa's argument. And before you dismiss it, look at what history actually shows us about what happens when this ratio gets stretched too far. In 1980, the gold backing ratio was back up to 18%. Not because the U.S. bought more gold, because the price of gold exploded during the 1970s, rising from $35 to $850 per ounce. The gold repriced itself to reflect the debt reality of its era. It did not ask permission. It did not wait for governments to agree. The market simply forced the recalculation, and the people who owned gold before that repricing turned modest positions into generational wealth. And now look at where we are today. The debt problem is categorically worse than it was in 1980. We are adding $2 trillion per year to the national debt, while the Federal Reserve has spent years signaling it cannot get inflation fully under control without breaking the economy. The structural conditions that drove gold's repricing in the 1970s are not just present today, they are amplified. And this is where the calculation starts to produce numbers that make people uncomfortable. If you wanted to reprice U.S. gold reserves back to the 18% backing ratio that existed in 1980, not 51%, just 18, the price of gold would need to be approximately $26,000 per ounce. If you wanted to get to 25% backing, gold would need to be around $37,000. And if you applied the 51% backing that existed during World War II, the number comes out to approximately $75,000 per ounce for gold. Now apply the gold to silver ratio of 19, which is the historically grounded ratio from the era when both metals were monetary instruments, and you get $3,947 for silver. That is where the number comes from. That is the math. And I checked it. It is correct. But here is where I start asking the questions that I think separate useful analysis from dangerous hype. Because my job in these videos is not to make you feel good about the metals you already own. My job is to give you the most honest, rigorous, real-world assessment I can. And when I apply that standard to Tavi Costa's framework, the first question I ask is this: is a return to 51% debt backing a realistic scenario in today's world? And my honest answer is no. No government on earth is going back to a formal gold standard. That conversation is simply not happening in any serious policy circle. The world runs on fiat currency, central bank credibility, and the petrodollar system. And while all of those things are under extraordinary stress right now, they are not about to be replaced by gold bars in a vault. So using 51% as your target backing ratio is the most aggressive possible version of this calculation. It produces the most extreme number, and I think intellectual honesty requires acknowledging that. But here is what intellectual honesty also requires acknowledging. Even if you cut Tavi Costa's target in half, even if you only go back to 25% backing, which is historically far more modest than what America maintained during its period of peak financial credibility, gold would still need to be around $37,000 per ounce. Apply a conservative gold to silver ratio of 35, not 19, and you get silver at over $1,000. Apply a ratio of 45, which is more moderate, and silver still comes out above $800 per ounce. From where silver is trading today, at approximately $80 per ounce after a significant pullback from its January all-time highs, getting to $800 would be a 10 times return on every dollar you put in. And I want you to sit with that number for a moment, not because I am trying to excite you, but because I want you to understand that even the most conservative version of this framework implies a magnitude of move that most retail investors simply cannot imagine. Now let me bring in the second pillar of Tavi Costa's analysis, because this is the part I find most compelling, and I think it is the part that gets the least attention when people talk about his work. This is the Dow Jones Industrial Average priced in gold. There's a chart that compresses over 100 years of market cycles into a single ratio. And that chart tells you something that no quarterly earnings report and no Federal Reserve statement can ever tell you. It tells you when stocks are genuinely expensive relative to real money and when they are cheap. The ratio is simple. You take the price of the Dow Jones and divide it by the price of gold. When the ratio is high, stocks are expensive relative to gold, meaning gold is cheap relative to productive economic output. When the ratio is low, gold is expensive relative to stocks, meaning gold has repriced to reflect financial stress. This ratio peaked in 1929, right before the Great Depression. It crashed down through 1933 as gold was revalued. It peaked again in 1966, right before a decade of stagflation. It crashed into 1980 as gold hit $850. It peaked a third time in 1999 at the height of the dot-com bubble at an all-time high of 44.8. And right now, today, the Dow-Gold ratio sits at approximately 9.7. In 1973, right at the moment before gold's most powerful bull market in modern history began, this ratio was sitting at almost exactly the same level it is today. From that point, the ratio fell all the way to 1-to-1 by 1980. Gold went from $180 to $850, a 4.5 times move in 7 years. The pattern has repeated 3 times in 100 years. Every single time, stocks became grossly overvalued relative to gold, gold caught up. Every single time. And we are sitting right now at the same entry point as 1973. Tavi Costa uses a target ratio of 2.5 for this cycle, not 1, which was the extreme low in 1980, 2.5, which is the conservative middle of the expected move. If the Dow stays roughly where it is today, around 49,000, and the Dow-Gold ratio compresses to 2.5, that implies a gold price of just under $20,000 per ounce. Now I ran my own more conservative version. What if the ratio only compresses to 5, which is not even close to where it went in 1980? At 5, with the Dow at current levels, gold needs to be around $9,800, still roughly double from here. What if it goes to 3.5? Gold comes out at 14,000. The point is not the exact number. The point is that regardless of where the ratio ultimately bottoms, gold has enormous room to run based on a pattern that is completed 3 times without exception in 100 years. And I am not smart enough, and frankly, neither is anyone else on this planet, to look at a pattern that has a 3-for-3 record over a century and confidently predict that this time it fails. The macro conditions that have driven every previous cycle, excessive debt, currency debasement, geopolitical instability, inflationary pressure, are not just present today. They are present in a more extreme form than in any previous cycle, because in every previous cycle, the debt eventually got resolved. In the 1930s, it was resolved through deflation and depression. In the 1970s, it was resolved through inflation destroying the real value of what was owed. Both of those resolutions were brutal and devastating for most people who lived through them, and both were exceptional for gold and silver. In this cycle, the debt has not been resolved. It has been expanded. $2 trillion per year of additional debt on top of a base that is already at $36 trillion. And central banks around the world, including the Federal Reserve, have been buying gold at record pace for 3 consecutive years, precisely because they see where this trajectory leads. Goldman Sachs reiterated its gold price target for year-end 2026 at $5,400 per ounce just days ago. The big institutions are not confused about what is happening. They are already positioned. And here is where I want to bring this home to silver specifically, because the macro framework I have just described, as powerful as it is actually only half the story. The other half is happening in the physical silver market right now, in real time, in the actual world of metal that exists in vaults and gets consumed in industrial processes that you cannot simply print more of. Silver hit an all-time high on January 29th of this year. It was a moment that shocked even the most committed silver bulls. The price ripped to levels that most analysts said were years away, and then it sold off, hard, crashing nearly 50% in the weeks that followed. U.S. Treasury Secretary Scott Bessent publicly attributed the extreme volatility to Chinese speculative positioning, describing the rally as a blow-off top driven by leverage rather than physical fundamentals. And that description is partially correct. There was a speculative component to January's spike. But here is what that explanation deliberately omits, and this is the part that matters for your understanding of where we go from here. The reason Chinese traders and global speculators were piling into silver in January was not random. It was not a meme stock moment where retail investors on a forum decided to squeeze a random asset. It was because the physical supply situation for silver is genuinely, structurally, dangerously tight. And that tightness did not disappear when the paper price crashed. If anything, it got worse, because the crash in paper prices made physical silver even cheaper relative to its actual scarcity, which accelerated physical buying, which is exactly what you're seeing in the data right now. The COMEX registered silver inventory, which is the silver that is actually certified, allocated, and available for immediate physical delivery, has been draining at a rate that has never been sustained before. Month after month, more silver leaves the vaults than enters them. The rate of drainage has been accelerating. And here is the detail that I think deserves far more attention than it gets. Silver miners, the companies that actually pull this metal out of the ground at massive cost and considerable risk, are right now receiving premiums above the official spot price when they sell for physical delivery. Not small premiums, meaningful premiums. That is a market signal of extraordinary clarity. When the people who produce the commodity cannot sell it at the official price because physical demand exceeds what the paper market represents, the paper price is not the real price. It is a fiction that eventually has to reconcile with reality. And the reconciliation is always violent. Always. Because markets cannot sustain a divergence between paper promises and physical reality indefinitely. At some point, someone who holds a futures contract and demands delivery either gets their metal or they do not. And if they do not, the entire structure of the paper market becomes suspect. We are moving toward that moment with a clarity that I have not seen at any previous point in my time covering this space. Now let me connect this to one more thing that most people are completely underestimating right now, and this is the geopolitical dimension. Today, as you're watching this video, gold is trading at $5,062 per ounce, up sharply on escalating tensions between the United States and Iran over the nuclear program. Silver is at $80 and climbing, up nearly 4% on the day, outperforming gold as both safe haven demand and industrial demand hit simultaneously. The gold to silver ratio currently sits at approximately 62.8. That number is critical. Here is why. In every previous precious metals bull market, the gold to silver ratio compresses dramatically as the cycle matures. In 1980, the ratio reached 35 to 1. In 2011, it reached 32 to 1. The current ratio of 62 means silver would need to do more than 80% better than gold from here just to get back to the 2011 lows of the ratio. And if this cycle follows the 1980 pattern, silver would need to dramatically outperform gold over the coming years. When the ratio compresses from 62 to 35, assuming gold merely stays at current levels rather than rising further, silver moves from $80 to over $144. But gold is not staying at current levels. Goldman Sachs has a year-end target of 5,400. Most serious analysts I follow have targets ranging from 6,000 to 9,000 by 2027. If gold reaches $7,000 and the ratio compresses to 35, silver trades at $200. If gold reaches 10,000 and the ratio compresses to 30, silver is at $333 per ounce. These are not the extreme scenarios. These are the moderate projections based on historical precedent, applied to current conditions. To talk to you about something that I do not think gets enough airtime in the precious metals community, and that is the industrial demand side of silver, because most of the conversation about silver is framed as a monetary metal discussion, a safe haven discussion, a hedge against inflation discussion, and all of that is true. But silver is also, simultaneously, the most industrially indispensable commodity on Earth for the energy transition that every major government on the planet has committed to. A single solar panel requires a significant amount of silver in its production. Globally, the solar industry is installing panels at a rate that is accelerating every year, and projections from the Silver Institute show that solar demand alone will consume hundreds of millions of ounces of silver annually within the next few years. Electric vehicles require silver for their electrical systems, their circuit boards, and their charging infrastructure. The artificial intelligence build-out, which is consuming enormous amounts of computing power, requires silver in every chip and every connection in every server farm being constructed at breakneck speed around the world. Defense electronics requires silver for precision guidance systems, communications, infrastructure, and sensors. Every single one of these demand streams is growing simultaneously, and silver mining supply has been largely flat for a decade. You cannot simply decide to open a new silver mine when demand spikes. It takes 8 to 10 years from discovery to production for a major mining project. The supply response to increased demand is glacially slow, which means if demand continues to outpace supply, and the data strongly suggests it will, the physical market tightness I described earlier does not resolve. It deepens. I want to give you my honest risk framework before I give you my final call, because I think anyone who tells you this is a one-way bet with no downside is either lying to you or lying to themselves. Risk number one is that central banks successfully navigate the debt situation without a currency crisis through some combination of fiscal discipline and structural reform. I think this is extraordinarily unlikely given the political realities of every major economy, but I'm not arrogant enough to call it impossible. Risk number two is that a severe global recession triggers a liquidity crisis where every asset sells off simultaneously, including precious metals, as investors scramble to raise cash. We saw this in 2008, where gold initially dropped before it rallied massively over the following years. A repeat of that dynamic is possible. If it happens, silver could get crushed in the short term even if the long-term thesis is completely intact. Risk number three is technological disruption of silver's industrial demand. If someone invents a commercially viable substitute for silver in solar cells or semiconductors, the industrial demand pillar weakens. I see no evidence of this happening in the near term, but dismissing it entirely would be intellectually dishonest. And risk number four is specific to the current moment. The paper price can be manipulated in the short term in ways that punish leverage positions before the physical reality reasserts itself. The 50% crash from January's highs is the most recent example. These corrections are real, they are painful, and they happen with frustrating frequency in the silver market. Position sizing and time horizon matter enormously. With all of those risks acknowledged, here is where I land. Tavi Costa's directional thesis is correct. Gold is deeply undervalued relative to the size of the debt it supposedly backstops. The Dow-Gold ratio tells us we are at the beginning of a major multi-year repricing cycle that has a perfect historical track record of completion. Silver will outperform gold during that cycle, because it always does when these ratios compress and when monetary demand meets industrial demand in a supply-constrained market. Goldman Sachs has already moved its year-end gold target to $5,400. The institutions are positioned, the central banks are buying, the physical market is tight and getting tighter. And the geopolitical backdrop is adding a war premium on top of every structural driver I have described. Where I disagree with Tavi Costa is on the precision of the final numbers. The $3,947 silver price requires both the most extreme debt backing scenario and the most extreme ratio compression to happen simultaneously. That is a tail outcome. Possible, not base case. My conservative case for silver, using modest debt backing assumptions and a ratio compression to only 45, gives me silver above $400. My base case, using moderate assumptions and a ratio of 35, gives me silver between $500 and $800. My optimistic case, using assumptions that are aggressive but historically grounded, gives me silver approaching or exceeding $1,000. The timeline Tavi Costa identifies, roughly 2030 to 2033, aligns with a historical pattern that shows these ratio cycles taking 7 to 10 years from the starting point we are at now. But there are catalysts that could compress that timeline dramatically. A currency crisis in a major economy, a sovereign credit downgrade of the United States, a sudden acceleration of de-dollarization, A central bank announcing silver reserve accumulation for the first time. A physical delivery failure on a major exchange. Any single one of those events could do in 2 years what the slow grind of structural fundamentals might otherwise take 7. And here is the number I want you to remember when you walk away from this video today. Silver is trading at roughly $80 per ounce right now. If it reaches $400, which is my conservative case, that is a 5 times return on every dollar you put in. A $10,000 position becomes $50,000. If it reaches $600, that is a 7.5 times return. A $10,000 position becomes $75,000. If it reaches $1,000, which is my optimistic but historically grounded case, a $10,000 position becomes $100,000. These are life-altering returns. And they do not require $3,947 silver. They do not require a return to the gold standard. They do not require any outcome that history has not already delivered multiple times. They only require the same thing that has happened in every single precious metals bull market across the last 100 years, which is that ratios that have stretched to one extreme eventually swing back toward the other. The Dow-Gold ratio has done this 3 times without exception. The gold-silver ratio has compressed in every major bull market without exception. Both of those patterns are in motion right now. Both of those patterns are pointing at the same destination. And the people who will benefit most from where this goes are not the people who buy when the move is obvious. They are the people who buy when the math says to buy, before the crowd arrives, before the mainstream media covers it, before everyone you know is talking about it. The people who bought gold in 1973 when the Dow-Gold ratio was exactly where it is today were told they were crazy. Gold had just been officially removed from the monetary system. Mainstream economists said it was a relic. The crowd was dismissive. 7 years later, gold was at $850, and the people who bought at $180 had changed their financial lives forever. The Dow-Gold ratio today is sitting in almost the exact same place it was in 1973. The debt situation is dramatically worse. The physical silver supply is historically tight. The institutional money is already moving. And the question staring you in the face right now is the same question that stared those 1973 buyers in the face. Are you going to act on what the data says, or are you going to wait until it is obvious? Because by the time it is obvious, the move that changes lives will already have happened. Let me tell you something that I think about every single time I sit down to cover this market, and I want you to really hear this because it is the thing that ties everything together. The entire above-ground stock of silver in the world, every ounce that has ever been mined and is still in existence in refined form, is worth approximately $200 billion at current prices. $200 billion. That sounds like a lot until you put it next to global debt, which is over $300 trillion. That is a ratio of 1,500 to 1. The entire silver market, one of the most critical industrial and monetary metals on the planet, is 1,500 times smaller than the pile of debt that the world has accumulated. And here is what that means in practical terms. If even a fraction of 1% of global debt holders decide to rotate into physical silver as a hedge, you do not need a global monetary reset. You do not need governments to agree on anything. You do not need a coordinated move. You just need a small number of very large money managers to make a decision that is completely rational given the macro environment, and the silver market does not have the depth to absorb it at anywhere near current prices. This is not speculation. This is arithmetic. And the arithmetic has been in silver's favor for years. The only question is timing. I want to address something directly because I know some of you watching this are thinking about the recent crash and you are scared. Silver going from its all-time high to down 50% in a matter of weeks is brutal. It is the kind of move that makes people question everything they thought they knew. And I understand that reaction completely. I have been covering markets long enough to know that volatility like that does not just test your investment thesis. It tests your psychology, your patience, and your conviction. But I want to put that crash in historical context for you because context is everything. In 1974, silver had a massive rally and then crashed over 50%. The people who sold at the bottom of that crash avoided the pain of the crash, but also missed the move from $6 to $50 per ounce that happened over the next 6 years. In 2008, silver crashed over 50% during the financial crisis. The people who sold at the bottom missed the move from $9 to $50 per ounce that happened by 2011. Every major silver bull market in modern history has included at least one 50% drawdown. Not some of them. All of them. The drawdown is not the end of the story. It is a chapter in the middle of the story. And what determines whether you benefit from the full story is not whether you can predict every correction. It is whether you understand the underlying thesis well enough to hold through the volatility that is a guaranteed feature of this market. The people who will look back on 2026 and wish they had acted are not the people who bought the all-time high in January. They are the people who watched silver crash from its highs, understood that the structural case was completely intact, and still did not buy because the recent pain made it feel too risky. That is the trap. And knowing it is a trap is the first step to avoiding it. Here is one more dimension of this story that I do not think gets nearly enough attention, and that is what is happening with global central bank behavior right now. For most of the last century, central banks were sellers of gold. They were actively reducing their reserves, treating gold as an archaic holdover from a financial system the world had moved past. That trend reversed definitively in 2010, and since then, central banks have been net buyers of gold every single year. But the scale of buying has accelerated dramatically. In 2022, central banks bought over 1,000 tons of gold, the most in 55 years. In 2023, buying remained near record levels. In 2024 and into 2025, the pace has not slowed. Goldman Sachs, in its latest report, confirmed that sovereign accumulation is re-accelerating in 2026, driven by the same fundamental logic I described earlier. Countries that hold dollar reserves watched what happened to Russia in 2022 and made a decision. They decided that dollar reserves held in Western financial institutions are not safe if you are ever on the wrong side of a geopolitical dispute. And they started buying gold, which cannot be frozen, cannot be sanctioned, cannot be seized remotely, and has held its value across every monetary system that has ever existed. This is not a fringe theory. It is stated policy of central banks across the developing world and increasingly in emerging markets that are explicitly positioning themselves outside the dollar system. And when you have sovereign buyers with essentially unlimited capacity making a permanent structural shift in their reserve allocation, the demand side of the gold market changes in a way that does not reverse easily. It has momentum. It has institutional weight behind it. And while central banks have not yet started buying silver, the logic that applies to gold applies to silver as well. And the day that even one significant sovereign wealth fund announces a silver reserve position, the market will react in a way that will make January's spike look like a small preview. I want to end with the most important thing I have said in this entire video, and I want you to hear it clearly. Because I think it is the sentence that determines whether this analysis changes anything for you, or whether it just becomes another piece of financial content you consumed and forgot. The investment case for silver right now is not built on hoping for a crisis. It is not built on doom or fear or the collapse of civilization. It is built on ratios, two specific ratios that have a combined record of 100% completion over 100 years of market history. The Dow priced in gold has compressed to its historical lows in every single cycle without exception. The gold to silver ratio has compressed in every single precious metals bull market without exception. Both of those ratios are stretched to extremes right now. Both of those ratios are beginning to move in the direction that history says they always move. You do not need to be a macro genius to understand this. You do not need a PhD in economics. You just need to look at the same 100-year chart that Tavi Costa looked at, that I looked at, that every serious investor who is currently accumulating silver has looked at, and ask yourself one question. Do I believe that for the first time in 100 years, both of these patterns fail at exactly the same moment? If your answer is yes, then silver is not for you. If your answer is no, then the math does the rest. Drop a comment and tell me which price target you think is realistic for silver. $400, $600, $1,000. Or if you are in the bear camp, tell me why and make the argument seriously, because I will pin the best responses from both sides. Share this video with someone who owns silver and has been shaken by the recent volatility, because what they need right now is not reassurance. It is the actual framework that explains why the crash was predictable, why the structural case is intact, and why the math has not changed even though the paper price moved dramatically. If you have not subscribed yet, do it now, because I cover this data every single day. The COMEX inventory reports, the miner premium data, the Dow-Gold ratio, the central bank purchase figures, the geopolitical developments that are adding a war premium on top of every structural driver in this market. You need to be watching this in real time if you want to understand what is coming before it becomes obvious. This is the hidden economy. Stay sharp, stay informed, stay positioned. Because the next time you check the price of silver and it is at a level that today seems impossible, you will know that you understood exactly why it got there long before the rest of the world caught up. That is the advantage of watching this channel. That is the advantage of understanding the math before the move happens. And that advantage is worth more than any single investment decision you will ever make. I want to hear 400, 600, 1,000, or if you think the bears are right, tell me that too, and tell me why. I read every single comment, and I will pin the most interesting responses from both sides of the argument. If you have not seen the breakdown I did on what is happening in the physical silver market right now, the COMEX drain, the minor premiums, the delivery stress, watch that next. Because the short-term physical squeeze and the long-term macro repricing cycle are telling the same story at the same time. That is rare. That is powerful. And that is exactly the kind of convergence that serious investors do not ignore.